All right, future CPAs, let's get into it. Today, we're diving deep into a topic that, let's be real, can be a little tricky on the FAR paper, but is absolutely crucial for the boards: the taxation of equity transactions. We're going to break this down, make it super simple, and hopefully make it stick in your brain for good.
So, here's our game plan for today. Think of it as your roadmap to mastering this stuff. We're going to tackle the 4 big taxes you need to know: capital gains tax, stock transaction tax, the tax on dividends, and the documentary stamp tax. And you're definitely going to want to stick around till the end, because we'll wrap it all up with an ultimate bullet review to really lock in all this knowledge for exam day.
First up, let's talk about capital gains tax, or CGT. Now, the main thing, the absolute key to remember here, is that CGT is all about private sales. So what does that mean? It means any sale of shares that happens outside of the stock exchange.
Okay, there are 2 phrases on this slide you need to burn into your memory: net profit and unlisted shares. Seriously. Unlike the other taxes we're going to cover, CGT is only calculated on your actual gain. You know, the selling price minus what you originally paid for it. No gain, no tax. Simple as that.
And what's the rate? Boom. 15%. It's a flat 15% final tax. That's it. It's that simple. There are no complicated brackets or tiers to memorize. If you make a net gain from selling unlisted shares, the tax is 15% of that gain. This number is non-negotiable. You've got to know it.
So, let's quickly tie all those pieces together. For CGT, what are we taxing? The net gain. What kind of shares? Unlisted shares. And here's an important little detail. This covers shares in both domestic and foreign corporations. And when does the tax kick in? The second that sale or exchange happens. Got it? Good. Okay, so now that we've nailed down the whole private seal thing, let's flip the coin and look at public trades. You know, when you're buying or selling shares on the Philippine Stock Exchange. For this, you're dealing with a totally different beast: the stock transaction tax, or STT.
Okay, right away, you should be spotting the major differences from CGT. STT is based on the gross selling price. What does that mean? It means the tax applies whether you made a profit or even a loss. And this tax is only for shares that are listed and traded on a stock exchange.
Now listen up, because this is a huge update and a very, very likely LCPA question. The Capital Markets Efficiency Promotion Act, or CMEPA, was a total game changer. It slashed the STT from 0.6% all the way down to where it is now. Why'd they do it? Basically, to make our stock market more attractive and encourage more people to invest by making it cheaper to trade. You absolutely have to know this change.
So, forget the old rate. It's history. The only number you need to remember for STT right now is 0.1%. Yeah, it's tiny, but it applies to the total value of every single sale you make on the market. This is the current official rate you're going to be tested on. Let's do a quick recap for STT. The tax base? Gross selling price. It applies to listed shares. And a pretty cool detail here is that this now also covers shares of domestic companies that are listed and traded on foreign stock exchanges too. And the trigger, it's the trade itself. Your broker just automatically deducts it. Easy peasy. Okay, so selling shares is one thing, but what about when you just hold on to them and the company you invested in is doing great? Well, when they share their profits with you, those are called dividends. And, you guessed it, they're taxed too. Now pay attention to that term, final withholding tax. Withholding is just a fancy way of saying the company paying you the dividend is required to do the math, deduct the tax, and send it straight to the BIR for you. So it's taxed at the source before that cash even hits your bank account.
The dividend tax rate isn't a one-size-fits-all kind of deal. It totally depends on who is getting the dividend. For an individual, like you or me, who's a Filipino citizen, it's a 10% final tax. For a non-resident foreign corporation, it's 15%. And then there's this really important one. Dividends paid from one domestic corporation to another domestic corporation are completely tax-exempt. Why? To avoid taxing the same money over and over again within the Philippines.
We are almost there. Hang in there. Our final tax is the documentary stamp tax, or DST. Here's a little study hack. Just think of it as the paperwork tax. It's basically a tax on the official documents that prove you own or are transferring shares. So, unlike CGT or STT, which are all about the trading, DST is more about the creation and the formalization of ownership through those official papers. This tax pops up whenever a company originally issues its shares.
The rate for DST on the original issuance of shares is 0.75% of the par value. Yeah, I know, it's kind of a weird random-looking rate, so make sure you flag this one in your memory. 0.75%.
So what exactly do you have to deal with this? Well, there are two main triggers for DST on shares. First, on the original issuance, when the shares are basically born. And second, when a company issues stock dividends. So even though no cash is actually moving around, the act of issuing those new share certificates is a taxable event for DST.
Okay, deep breath. You've absorbed a ton of information. Now, let's put it all together and make it crystal clear. This next slide is your ultimate cheat sheet. Seriously, if you can master the summary, you have totally mastered this topic. Here it is, all 4 taxes, side by side. Let's run through it. CGT is 15% on the net gain from unlisted shares. STT is a tiny 0.1%, but on the gross price of listed shares. Tax on dividends depends on who gets it. And DST is 0.75% on the par value when shares are first issued. If you can just remember these key distinctions, listed versus unlisted, net versus gross, and sale versus issuance, you are golden.
And that's pretty much the whole shebang. Master these rules, especially the key differences we just covered, and you'll be more than ready to crush any equity transaction question that the board exam throws at you. You've got this.
So I'll leave you with one final thought, something to take you from just memorizing the rules to really thinking like a CPA. With the stock transaction tax now at a super low 0.1%, how do you think that might change things? Will more companies decide to go public? Will it encourage more people to day trade? Think about the ripple effects. That's how you really start to own this knowledge. Good luck with your review.